Fed Chairman Ben Bernanke is faced with a dual mandate of boosting employment but maintaining price stability. Will quantitative easing by the Fed meet that challenge? Alan Sinai is CEO and Chief Global Economist at Decision Economics and a longtime Fed watcher. He joins us now from our Chicago newsroom. Dr. Sinai, welcome back to Bloomberg. Always good to have you on.
Well, nice to be with you.
Sir, all this talk of QE2, quantitative easing 2, is that all the Fed has left in its arsenal at this point?
Maybe. They're loud and clear. They have a job to do. Let's kind of get out of the code of the Fed. The economy is growing far too slowly. The unemployment rate's far too high. And inflation, as a consequence, is lower than the mandated level. That's about 1.5–2% on the core you talked about. So zero interest rate hasn't worked. Credit hasn't worked. They're going to expand their balance sheet and buy securities directly in the open market. They're going to buy treasuries, try to get interest rates on the longer end down, and hope that will help the economy.
Dr. Sinai, what's that expansion of the balance sheet going to mean for liquidity?
Certainly, there's a lot more liquidity in the system. They're essentially printing money, printing dollars. It's part of why the U.S. dollar is going down. With lags, a lower dollar should help our exports. That should help our growth and help firm prices. And lower interest rates, not just treasury rates, but mortgage rates, if they can keep them low. They have to stay in the market and keep buying treasury securities to do that. Maybe he'll tell us more about that tomorrow. Maybe he won't, but that's what they'll have to do. Mortgage rates would be lower, corporate rates lower, municipal rates lower, and those sectors will be able to refinance at lower rates, save some money, and over time, maybe that will help.
You talked about the U.S. dollar. These efforts to ease monetary policy, what's that going to do to the value of the dollar? Is it going to weaken it further?
Absolutely. We have a central bank that's going to print money. It's going to try to raise inflation. A lower dollar helps the Fed achieve its goals. No one at the IMF World Bank meetings, none of the central bankers or China really did anything about the currency. It's a wide open territory to sell the dollar down as far as the traders and investors want to take the dollar. So there is no real downside. It's going to go down. It is going down. It's going to go down more.
Do you see any parallels between what the United States is going through right now and what Japan went through in the 1990s?
It's a great question. I used to say, no, we're not like Japan until about 3 years ago. My Japanese friends kept telling me, it's just like us. And I said, no, it can't be. Guess what? Much of what's going on is just like Japan.
What changed your mind, sir?
What changed my mind is we weren't growing much. Inflation kept coming down. But mainly, we've done policy just like they did. It never worked for them. We go to zero rates. We pump funds in. The private sector doesn't use the funds. The banks don't put them out. And we do fiscal policy by government projects. And if that doesn't help the economy, the government spending doesn't help the economy. When you're done, you're left with deficits and debt, but GDP fades.
Right.
And that's what happened to Japan, and they ended up with deflation.
Dr. Sinai, in our last 30 seconds, how does this landscape change following the November elections? Because there's going to be a political component to this, whether people want to admit it or not.
It'll change through fiscal policy. And probably a more responsible Washington in terms of deficits and debt. And let's hope that on the side of stimulus, we turn more to tax stimulus rather than government spending stimulus and rein in the growth of government spending. That would help a lot. That thrust would help a lot.
All right, Alan Sinai, CEO, Chief Global Economist at Decision Economics, joining us from Chicago. Dr. Sinai, it's always a pleasure to have you on. Thanks so much.
My pleasure. Thank you.